Ever wonder what truly drives a company's financial success? It's not just about profits and losses, it's about the story behind the numbers. Welcome to Exploring Financial Ratios, unveiling the essence of financial performance. Today, we're diving deep into the world of financial ratios, those secret codes that decode a company's financial health. We'll unravel the mystery behind income statements and balance sheets, and how they come together to reveal the big picture. Get ready to unlock the art and science of financial ratio analysis. Let's jump in. You might be thinking, why should I care about financial ratios? Well, let me tell you, they're the keys to understanding a company's financial performance in a way that goes beyond the surface. Imagine you're looking at a beautiful painting. From a distance, it's appealing. But only when you examine the intricate brushstrokes up close do you truly appreciate its artistry. In the same way, financial ratios allows us to zoom in, revealing the details that make up a company's financial masterpiece. Financial Ratio Foundation. To embark on our journey into the world of financial ratios, we need two essential documents: the income statement and the balance sheet. Consider the income statement as a snapshot of a company's profits over a specific period, like a year. It tells us how much money the company made and how much it spent during that time. Now, the balance sheet provides a snapshot of the company's financial position at a particular moment. It's like taking a photo of everything the company owns and everything it owes right now. These two documents are our tools for unraveling the story behind the numbers. Part 1. Understanding Income Statement Ratios. Now that we've introduced our foundational tools, the income statement and balance sheet, it's time to delve deeper into financial ratios, focusing on the income statement. These ratios shine a spotlight on a company's profitability, providing valuable insights into how effectively it generates earnings. Picture this: Alpha Corp and Beta Corp, our fictional companies, compete in the same industry. Alpha Corp reports a gross profit margin of 50%, while Beta Corp lags with a 30% margin. That significant 20% difference reveals that Alpha Corp is making substantially more profit on its products or services. But let's not stop there. Digging deeper into the income statement, we find the operating margin. Alpha Corp boasts an operating margin of 21%, while Beta Corp has an operating margin of 14%. So, the initial 20% gross profit margin gap narrows to just 7% at the operating margin level. What's driving this discrepancy? Upon closer examination, the Alpha Corp spends 20% of its revenue on selling, general and administrative expenses, or SG&A, while Beta Corp spends only 10%. This disparity suggests that Alpha Corp may need to spend more in non-manufacturing areas like sales, marketing, finance, HR, and IT. This could be due to each company's industry, their strategic choices, or differences in operational efficiency. It's a compelling mystery worth investigating further. Another interesting observation is the research and development, or R&D spending. Alpha Corp invests more heavily in R&D than Beta Corp. This is typically seen as a positive sign, indicating that Alpha Corp is committed to innovation, which may lead to future high-margin innovative products and services. Part 2. Delving into balance sheet ratios. As we pivot to balance sheet ratios, we'll explore metrics that help us assess a company's liquidity and financial structure. Imagine you're a supplier or creditor and want to know if a company can meet its short-term obligations. That's where the current ratio comes into play. Alpha Corp has a current ratio of 2, meaning it has twice as many current assets as current liabilities. This indicates a safe position, ensuring business continuity. On the other hand, Beta Corp's current ratio is 0.5, implying that it has only half the resources needed to cover its short-term obligations, making it a riskier proposition for creditors. Now, let's talk about the debt-to-equity ratio. Alpha Corp has a conservative ratio of 1:7, signifying a robust financing strategy with a substantial equity buffer. In contrast, Betacorp's ratio is 4:1, indicating a heavier reliance on borrowed capital, which can be riskier in the face of future losses. Considering equity as a percentage of the balance sheet total, Alpha Corp stands at 70% while Beta Corp is at 12.5%. These figures underscore Alpha Corp has lower leverage, whereas Beta Corp carries a higher financial risk. Part 3. Uniting the income statement and balance sheet. Let's unite the income statement and balance sheet to reveal even deeper insights. One of the most telling ratios is return on equity or ROE, calculated as net income divided by equity. Alpha Corp's ROE is 22.9%, while Beta Corp's is a whopping 80%. At first glance, it appears that Beta Corp is the clear winner. However, it's not that straightforward. While Alpha Corp boasts higher profit margins, as we saw in the income statement analysis, Beta Corp relies on higher financial leverage, as indicated in the balance sheet analysis. There's also the asset turnover ratio, which measures how efficiently a company generates revenue from its assets. Alpha Corp has an asset turnover of 1, while Beta Corp's is 1.25, implying that Beta Corp is utilizing its assets more effectively. Now, let's zoom in on two critical subsets of the asset turnover ratio. First, receivables turnover measures how quickly a company collects its accounts receivable. Alpha Corp's ratio is 6.67, whereas Beta Corp's is 20, suggesting that Beta Corp gets paid by customers significantly faster. Next, inventory turnover reveals how efficiently a company manages its inventory. Alpha Corp has 5 inventory turns, while Beta Corp has 10, indicating that Beta Corp is selling its inventory at a faster rate. So, who's in better financial shape, Alpha Corp or Beta Corp? It's not a simple answer. Financial ratios provide us with a clear understanding of a company's economic landscape, but they don't make judgments. They're tools for deepening our comprehension of a company's strategic and operational story behind the numbers. In the world of finance, understanding financial ratios is both an art and a science. It's about decoding the intricate brushstrokes that make up a company's financial masterpiece. We've only scratched the surface today, but these ratios are your gateway to the fascinating world of financial analysis. Whether you're an investor, a business owner, or simply curious about the financial health of the companies you encounter, mastering financial ratios is valuable. And there you have it, our journey into the world of financial ratios. We've peeled back the layers, deciphered the numbers, and uncovered the secrets that lie within a company's financial performance. Now, it's your turn. We want to hear from you. What financial ratio intrigues you the most? Or do you have questions about any ratios we've discussed today? Drop your thoughts in the comments below, and let's continue this conversation. If you found this exploration as fascinating as we did, remember to hit that like button to show your appreciation. And if you're hungry for more insights into the world of finance, business, and accounting, subscribe to Kountin Koins' YouTube channel. By doing so, you'll be the first to know when we dive into other intriguing topics that demystify the complexities of the financial world. So, until next time, keep counting those coins of knowledge, and remember, understanding financial ratios is your key to making informed decisions in the ever-evolving business landscape. Thanks for